Okay, in this video what we're going to be talking about is trend versus bias. There is a difference. Bias is more important, and here's the reason why. When you have moving averages on a chart, or whatever it is that you use to determine trend, when there is no trend, that's where you're going to be get in trouble. When the market moves into consolidation, a lot of times, especially as beginning traders, we tend to buy the tops, buy the highs, sell the lows, and we get whipsawed. Choose through our account, we get very frustrated. You look at the chart, you go, how in the world am I supposed to be able to figure this out? When price goes up just enough to indicate an uptrend, and then it turns around and goes back down, and so forth. And when the ranges are a couple of points, it can be a very difficult thing, especially depending on the market that you're choosing to trade. What we're looking at here is a chart of the E-mini Russell, but it doesn't matter what market that you're actually looking at trading. This is the E-mini Russell. We have three Kaufman adaptive moving averages on here set to 3 different time frames, and they work the same as moving averages, but they're a little bit less responsive, which is specifically why I like to use them. During these times of consolidation, the market, when it consolidates, they tend to filter out some of the false signals. So what we're going to look at is a few areas here that are definitely going to be going to be trouble areas. And you've got this area here where the market has moved up, made a lower low, or a higher low, excuse me, and then a higher high, and then it fails to make a higher high here, indicating that it's still in an uptrend. It does tend to make lower highs. There are a couple of lower lows, but the bottom line is this is really just cranking along. It's kind of grinding sideways but down. I chose to show you this just simply because it's when you're just getting into this, you could definitely get whipsaw. The ranges are enough. Using simple moving average theory, where the faster of the moving averages is going to be below the other two in a downtrend and up in an uptrend, we can clearly see here that the bias is to the downside. So your areas of opportunity to go short are going to be here, here, and here. Point being, you're not going to buy long here, go short here, buy long, go short, buy long, that type of a thing. It keeps you out of trouble there. That becomes more obvious here on this particular area, where the market is definitely going sideways. There are no higher highs being made and lower lows being made, so you don't really know what's going on. The slowest of the averages is going fairly sideways, but again, basic moving average theory would indicate that the bias is to the upside, and there's a difference between in your mind between bias and trend. You're not looking necessarily at trend, you're looking just for bias, because as you come out of a trend when you're trading and into congestion, you don't know you're in congestion yet, and you need something to tell you, okay, this is what you should be looking for. It'll at least keep you on the better side of the market. So your areas of opportunity to go long are going to be here, here, between here and here, and in here. So that's definitely going to be better than going long up here, 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 or here. So that's a good example. Here's another example where it's a little bit more messy. Market comes down, after a big push down, comes back up, and then the fastest of the 3 averages is above the slowest of the 3, and then the second fastest is, the fastest is above the slowest of the 3. The second to the fastest is below the slowest. So you really split, you have no bias here. At this point, the market starts to move down and it pulls these averages down here, and so this is where you start to see them starting to agree. Your area of opportunity to go short would have been right up here. If you did go short, you would have had to grab your profit quick, or you'd have been stopped out around here. At this point, price pulls up the averages. The bias is to the upside. Your areas of opportunity to buy and go long are here and here. So again, just to recap, bias is different than trend. Bias is more important than trend, because in this situation, you're going to know trend and bias. Whereas if you just look at moving averages to help you with a trend, they're gonna get crazy when it comes to consolidation. So it doesn't have to necessarily be Kaufman adaptive moving averages that you use. I wanted to give you the theory of everything for the most part, and you can run with it from there, and just kind of build a system around there. You can use this system or the theory with any moving average, and you could use it with other things as well. So the idea is, though, get yourself thinking and looking for bias, overall bias of the market versus what's the trend. And then once you've got the bias, then you can look for immediate trend if you're looking for a momentum trade. That's it. Hope this video is useful. I'll do some more as time permits, and try to knock out some other things that are useful for you. Take care.